Good afternoon, everyone.
Good afternoon.
Good afternoon. Nice to hear you're here. This is a very, very special event this afternoon. A very, very timely topic. And a set of panelists who could not be better qualified to talk about these important issues. These are issues that we're concerned about institutionally. Whatever institution we come from, we happen to be at the university, so I've been talking with my investment officers, and whatever money I thought I was going to have next semester is a lot less than I thought it was going to be, because the Annenberg endowment has gone down. I was talking with one of our funders from a very large California corporate foundation. They just said they have $1 billion less to give out this year to worthy recipients than they had last year. So it's a challenge for all of us institutionally. It's a challenge for the next administration, whoever wins on Tuesday. And I hope you will all vote at least once on Tuesday. And it's also, of course, a challenge in our personal lives. The issue of financial democracy and the great credit panic of 2008, exploring media's role, could not be more timely. I want to again welcome all of you for coming. I want to welcome the panelists who have taken time out from their busy days also to join us. And I especially want to thank Chris Smith for putting this together in a very imaginative way, in a very timely way.
Especially with the bacon.
I unfortunately have to take off to go to play in the band out here.
Literally.
When we have special guests, we bring the entire band out.
Very fun.
But let me again welcome all of you here. I know it's going to be a very robust and interesting conversation. And I turn it over to Chris. Thank you. Right on cue. Right on cue.
Well, welcome everyone. I really appreciate you coming down at this very busy time of the semester. And on behalf of the Johnson Center Advisory Board, I'd like to thank Dean Wilson for making this event possible. I'd like to thank Associate Dean Carola Vile for all of the tremendous support she's given to the Johnson Center. I would definitely be remiss if I didn't thank Jeff Cowan, Jeff Baum, and Rebecca Shapiro from the Center on Communication Leadership. Their efforts toward this event and toward the Johnson Center in general have just been absolutely invaluable. I'd also like to thank the director of the COM program, Larry Gross, faculty colleagues like Bill Sellis and John Taplin, among many others, who continually keep the dialogue around the issue we're going to discuss today, among many others, going in the hallways, in informal interactions, and over email during committee work. I want to thank all of them and everyone on the event, Annenberg event team, for making everything possible. So a little bit about the Johnson Communication Leadership Center. It was established in 2007 through a very generous gift from Lyndon Johnson Rice, who's the president and chief executive officer of Johnson Publishing Company. And the Johnson Communication Leadership Center's central aims are to support early-stage career development for African-American journalism and communication students, and to expose all of our students to important industry leaders and academic practitioners who impact the communication field. So I'm delighted that on this afternoon, our distinguished panel has granted the Johnson Scholars and the broader Annenberg community just such an opportunity for intellectual and professional enrichment. Now, it's important to remember at this juncture that Johnson Publishing Company has thrived as a closely held private company across 2 generations, and though not immune to the maelstrom of change sweeping across the traditional media landscape, it has never wavered in its belief that the free market has a strong role to play in the socioeconomic advancement of African Americans, people of color, and indeed all the nation's citizens, irrespective of background or lineage. So it's in that spirit, as Dean Wilson already indicated, the spirit of bolstering our shared commitment to equal opportunity for all, that we gather here this afternoon to examine the factors behind our current financial crisis, certainly one of the most complex and troubling threats aligned against American prosperity, and to consider how media organizations and professionals who work for them might help us to deal with it successfully. And so again, our topic today is financial democracy and the credit panic of 2008, exploring media's role. I'm going to begin, I'll be standing here the whole time, so don't be shocked. But I'm going to begin with introducing Suzanne Nora Johnson, who almost needs no introduction, have a few moments of conversation with her, and then continue by introducing the rest of our panelists and move forward with the discussion. So without further ado, I'm just absolutely honored and delighted to introduce at the center of the table Suzanne Nora Johnson, who is the former vice chairman of the Goldman Sachs Group. She had been at the firm for more than 2 decades in roles including the head of the Global Investment Research Division and the chairman of the Global Markets Institute. She currently serves on the as a director on the boards of AIG, Intuit, Pfizer, and Visa, and she also serves on the boards of several nonprofit organizations, including the American Red Cross. She chairs the investment committees at the University of Southern California, hence the band heralding her line, and the Markle Foundation. She's a native of Chicago. She earned a JD degree from Harvard Law School and a BA degree in interdisciplinary studies from right here at University of Southern California. So join me in welcoming Suzanne. So Suzanne, 2008, a year that definitely will go down in the history books. We've seen this year the reshaping of the U.S. financial system before our very eyes. We've seen the rapid devolution of some of our oldest and biggest names in American finance, from Bear Stearns to Fannie Mae and Freddie Mac, Lehman Brothers, Merrill Lynch, and AIG. And even Morgan Stanley and your old firm Goldman Sachs have been embroiled in this situation and have had to revamp their business models accordingly. So in your judgment, what has happened? Why are we where we are today? And what more do you think ought to be done to restore trust and confidence in the system?
Chris, first of all, thank you very much for the invitation, and it's a real honor to be with my colleagues around the table and with all of you, and I'm actually very interested to hear, hopefully, some back and forth a little bit where you think we're all wet or where we've missed things. I just got a couple observations I wanted to make off the top, and it is obvious to say, but we're living through very extraordinary times. And you really have to look back to the last 5 to 10 years to understand really how we got here. And many of the reasons we got here were actually very positive. If you remember kind of post 9/11 in particular, all of a sudden interest rates and inflation, importantly, around the world were at historic lows. And that really propelled extraordinary economic growth in many parts of the world that had not seen growth. And I think all of us would say that was a very positive thing. The emergence of China in particular probably brought down inflation around the world in many ways, and people who had not been part of the world trading system all of a sudden really had access, and that was a very positive thing. As a part and parcel of that, though, and you can all probably remember this if you remember 9/11, there was fear in the U.S. market in particular about where to put assets. And housing became the great American hope for all parts of our society. I don't know if you all remember, if you go back and look at some of the journalism of the time, what you see is, what's the one place that I can put my money and have it be safe? It's a house. And everybody needs a house. And so again, many, many Americans actually bought houses as part of that. And I think we would all say that those values overall were very positive things. The corollary of those things were that whenever you have that kind of macroeconomic environment, you get asset bubbles. And there really has never been effective ways in the economic kind of regulatory arsenal of how to prick asset bubbles. And in fact, there's always debate about whether you should prick asset bubbles. And in particular, housing was a very controversial one to prick. I sat with some Fed governors last week who are now, as you all know, in the hot seat about, along with Greenspan, how could they have let this run wild in the U.S. And one of the more honest members said, you know, we sat around a table in a discussion about this, and we said to ourselves, well, if someone in a hedge fund or private equity is getting a 30% return a year, why shouldn't we let the average American let their housing and their real estate investment, which is the one investment they'll have in their entire life, run as well. And so again, I don't think people were necessarily ill-intentioned, but they certainly didn't respond in a very thoughtful way. If you look then at the micro factors that I'd say were probably the most significant, one was, as part and parcel of this housing bubble, financial institutions were given a lot of guidance about getting risk off of their balance sheets. And again, if you went back to the journalism of the time, or if you looked at the conventional wisdom from the regulators and the central banks, they used securitization to basically say, we want risk off financial institution balance sheet. We think this will be more stability. And we also think, given how strong housing is as an asset class, it would be a benefit to let many investors basically buy a slice of a portfolio of housing, i.e. a securitized instrument. Now, in those micro developments, two things happened. One is when people were getting mortgages, and I'm sure many of us around the room who either have mortgages or have friends have mortgages know, almost anybody could get a mortgage under any terms. And those terms tended to be more outrageous the lower in the income spectrum you went. And by outrageous, I meant there wasn't a lot of education on the other side about what it meant to have a floating rate versus a fixed rate mortgage. Most people couldn't tell you what resets are. And in fairness, if you take a poll of the average American at any income level, they can't explain to you how a fixed rate mortgage works. They don't understand what part are you paying for interest, what part are you paying for principal. So if you take that as a given, that was a very dangerous situation to occur. So again, don't think I'm saying it was the lower half of our society, it was the entire society, but some people were even more at risk because there were no tools available to them to deal with it. And the other issue I'd say on the securitization front, as you all know, people basically bought securities without really kind of knowing what they were buying at any level, and that's very sophisticated investors as well. And also, the rating agencies that basically allowed them to be sold didn't necessarily model all what I'll call tail risk. What was the small chance that you'd have complete meltdown across the sector? And so I'd say, just as an overview, those are probably the backdrop of really why we are here today and what they kind of precipitated what I'll call the financial crisis.
Fantastic. And Sandy Green will certainly be speaking more about asset bubbles. Dr. Deng will be speaking more pointedly about the real estate basis for all this. But Suzanne, you just came back from Washington not too long ago, as we were just discussing upstairs. What's your take on the leadership and the posture of crisis management that's been exerted on this meltdown? Has it been enough? Did people step in early enough to stop even worse damage to the overall economy?
Well, Chris, part of the reason I was so delighted to be here today is I actually think the people in this room have a critical role to play in situations like this. I spent about a month on the Hill, both before the first bailout bill and then after it got accepted. And I was mentioning to Chris, what was most shocking to me was that the average congressman or woman, and it didn't matter how sophisticated or smart they were, absolutely did not understand the bailout bill, but more importantly, they had no idea how it was connected to the real economy. And they had that lack of knowledge during a time when their constituents, as you all know, were screaming about them accepting a situation where they were bailing out not a very sympathetic crowd up in Wall Street. And it was very clear that much of the media did not have the ability to really be an informational source that could help connect the dots. And the media that they were pointing to for their reference points, again, I'd say were more sensational in many ways than they were helpful. And I don't care whether you're talking about NPR, New Yorker, CNBC, the New York Times, the Wall Street Journal. No one was providing that kind of leadership and guidance. And I think the very thoughtful people on the Hill who were getting very strong constituent response, they didn't really have anything to fall back on to explain why should I do this or do I even understand it. And why I say your role is so important is there was going to be some very dramatic impacts on the rest of the real economy. Forget about the villains and the greedy people on Wall Street. It was really that impact on the real economy that you had to have some view on to kind of come to a solution. And there really wasn't a lot of sources of information out there. And I was telling Chris, I ended up on the Hill only because a number of friends in Congress on both sides of the aisle had said, will you come down and basically kind of do tutorials, again, without an agenda of what we should do. Just give us really the basics of the way that the economy works. And then you also saw that they were also faced with an administration that really had no credibility. And the administration, for whatever reason, did not decide to use a very effective political communications device. One, everything from what they named the bill originally to Hank Paulson basically saying, you have to trust me and you have to do this. Which again, I think, gives a lot of lessons to kind of political leadership. What did you need to do in a situation where, one, there was a very unsympathetic bad actor out there, and you needed some really complex solutions to a very difficult problem.
And George Alexander, editor-at-large of Black Enterprise, and Kathy Kristof, syndicated personal finance columnist, will certainly speak more directly to the issue of media's role in helping to repair some of this damage going forward. Suzanne, what do you think it will take for us to turn the corner from this morass we're in?
And Chris, I think you did highlight a lot of this is confidence. And I do think that there is no doubt across all sectors of the economy and the population, people's confidence has been shaken to the core. And it may be because of their own personal experience. Either they don't have the retirement funds they thought they had, they don't have the college funds, they can't pay for their mortgage, they've just lost their house. I think everyone is going to be shook up for a long time, and I don't think that gets cured overnight. You're going to also have to have kind of the really basics of the economy kick back in. And if you remember, our economy has really been a consumer-based economy for years and years and years. And people don't go out and buy things when they see their retirement accounts are nothing in them, their house, they don't have any net worth, and they don't have their job. And so until those kind of basics of the economy are somewhat stabilized, hard to bring back confidence. But I do think a first step would be getting people to understand that the leadership knows the nature of the problem, and they can connect everyday people with what is the pathway to getting some stability back. And even having China still have relatively robust growth, albeit reduced growth, I kind of view as a positive. And the more you can use this as kind of an educating moment to have people understand how connected the world is and how that is advantageous to the U.S. and kind of our pathway back, it's those kinds of things to me that ultimately will be a good thing for the U.S.
Well, you mentioned China. In your view, will the rest of the world continue to be supportive by buying our products and our debt as we make our way through this?
Well, I think we're in a very vulnerable position in the sense that you have incredible geopolitical risk whenever people have basically a concentrated leverage against you. That said, the people on the other side of the trade, i.e. the Chinese, desperately need our market to be healthy until their own domestic markets kind of grow up. And I think the Chinese and the Indians, the Russians have all been very thoughtful about trying to ignite consumer markets, and I'm sure my colleague can talk at great length about this. When you saw the land reform in China in the last month, I mean, that's in large measure to hopefully kind of spur economic growth in some of the places that have been left behind in China, and to offset some of the declines that will absolutely occur because of the contraction of the U.S. market. But I think longer term, that's a very positive sign.
Mm-hmm. And finally, a lot of folks have been calling for regulatory revision for quite a while. Why do you think those calls were unheeded for so long?
Okay, well, I'll try to give you my non-cynical answer. Whenever a bureaucracy is built and there's power in it, you don't want to give up power. And we've got, in the United States, among other kind of advanced economies, and even some of the most important developing economies, our regulatory system is completely fragmented, overlapping, not consistent. And often kind of more focused on enforcement as opposed to kind of prudential organization of an industry. So then you had that on one side, so that there was no reason the beast wanted to reform itself. And then secondly, if you think about industry, and I would point to the financial services as among one of the most spendy in Congress, they spent a lot of money kind of lobbying at the very kind of simple reform level of what they did and didn't want. And I give you the example of the bankruptcy bill a number of years ago, which really would have been unheard of to get through Congress years ago. This was something that gave, again, lenders disproportionately more power in a bankruptcy situation, which, as you can imagine, now that we're in a mortgage meltdown, has profound implications for the average consumer. The industry was very, very aggressive in pushing for that legislation, and that had regulatory impacts. Again, that there was no counter in terms of spending from a lobbying perspective to offset it.
Thank you very much.
They have fair value accounting now, right? I mean, that's the new battle, and it's equally disturbing, frankly.
Absolutely. Well, let me bring the rest of the panel in. We're very delighted today to be joined by George Alexander, who was recently named editor-at-large at Black Enterprise magazine. Prior to joining Black Enterprise, George was a media and entertainment banker in New York. He's presently an author. His latest book is Queens, Portraits of Black Women in Their Fabulous Hair. He also has a fantastic book called Why We Make Movies. Black filmmakers talk about the magic of cinema. He's also a screenwriter, and he's written, in addition to Black Enterprise, he's written for AOL, Daily Variety, Forbes, VH1, The Biography Channel, Essence, Ebony, and HBO.com. To George's right is Dr. Yongheng Deng, who is a professor and director of doctoral programs at the School of Policy, Planning, and Development here at USC. Dr. Deng has published numerous articles on the topics of mortgage-backed security, securitization, and real estate capital markets for a variety of journals, including Real Estate Economics and Regional Science and Urban Economics. And he's currently on the editorial board of Real Estate Economics. And prior to joining USC, he served as economist and expert in the Office of Federal Housing Enterprise Oversight, a financial regulator overseeing Fannie Mae and Freddie Mac in Washington, D.C. And he holds a PhD in economics from the University of California, Berkeley. And to Dr. Deng's right is Sandy Green, who many of you here at Annenberg are familiar with from his various seminar presentations here. He received his PhD in business studies from Harvard Business School. He also has an MA in sociology from Harvard and a BA in economics and rhetoric from the University of California at Berkeley. He's published numerous journals on rhetoric and valuation, and his current research focuses squarely on the role of rhetoric in the valuation process and its effect on asset bubbles and crashes. And finally, immediately to my right is Kathy Kristof, who again, many of you are probably familiar with from reading her work in the LA Times, among other venues. She's a syndicated financial columnist and an author of Investing 101 and Taming the Tuition Tiger. She's a 25-year veteran of financial journalism who spent the bulk of her career as a financial reporter at the Los Angeles Times. She's now writing columns, books, and magazine articles from right here in Los Angeles. George, turning to you, on October 9th, Robert Shiller, the Yale economist, wrote that the financial crisis is a failure of financial democracy and that it's symptomatic of a split between the information rich and the information poor. And he called at the end of his editorial for popularizing agents for financial literacy. And in the piece, he named Susie Orman as one of those, whether you like her or loathe her, as being someone he views as at the vanguard of popularizing financial literacy.
I'm sorry, there are a few primal screams.
I knew that would get a charge of people. But what do you make of Schiller's basic idea that this crisis reveals a fundamental gap between those with financial literacy and those without? And how does Black Enterprise seek to fill that gap?
Right. I think his point is very telling. I think there's a lot of information available to us, perhaps more information than ever before. But I think we have to look at this information in the context of what's going on in our larger society, where financial news is competing with everything. Because I think at the end of the day, news organizations are competing for our time. So when we come home from work, we have a choice to rent a movie, do Facebook, gaming, all these options, and then maybe I'll look at my financial news and keep up with what's going on with my 401k. And so the reality is that these organizations are are racing against the gun. I mean, so if you look at the news today, you see that Time Inc. is laying off people, Gannett. And this isn't an accident. It's because we're not necessarily reading newspapers anymore. We're not paying attention. So I think a lot of this happens in this context. And so I think the information is there. How do we make readers pay attention to the information that is most important to them, that's affecting their lives? And so at Black Enterprise, we do try. We've done stories on avoiding predatory lenders or being prepared for mortgages. We talk about wealth building all the time. Yet, we're just one publication. And also, I think you have to look at this in the context of a culture that's also somewhat, if you will, addicted to entertainment. I mean, we like entertainment, but entertainment is a big export for America. I don't think it's a bad thing, but it's at the same time, it sometimes gets equal weighting. So I think this financial crisis isn't something new. I think the financial crisis has sort of been bubbling. I think the financial crisis has sort of been bubbling beneath the surface for a while. I mean, there was a study by the Commerce Department that came out in 2006 that looked at the first time since the Great Depression we had negative savings in America. The first time, but that wasn't front page news. It wasn't something that was talked about, no red flags, no one was alarmed. It was probably competing with Anna Nicole Smith and things like that that get equal weight sometimes in the media. So you have to, I think Suzanne hit on a very important point that what's our role? Because the news broadcast will say that they show us and tell us what we want. We drive the engine, but we could argue that all day too, who's driving all of this. In defense of Susie Orman, one thing she will say sometimes is that, and one thing she talks about is look out for yourself. Always look out for yourself. Save money for yourself. When the government was saying they're going to see that text, that the check this past summer, she said, well, pay down your debt first and look out for you. Don't go out and spend. But I do think that this consumer culture of spend, spend, spend at all costs, all this is happening in the context of a culture that's been sort of addicted to debt or driven by credit card debt, which is another big crisis that is predicted to be lurking in the next big ball to drop. So I think we do at Black Enterprise our mandate is to try to educate our readers as much as possible about this, but it's still a difficult challenge to break through to everyone.
Mm-hmm. And just real quickly, what would you say is the primary age demographic or other salient demographic market breaks for Black Enterprise readers?
Yeah, I mean,
beyond the obvious.
Yeah, you're talking about college educated, whose median income is above the average. So in age, we're talking about 35, or around 35 median. But I think that still, recently, and as a marker of whether or not we're breaking through or not, still African Americans trail in terms of contributions to 401k plans. 50% less in terms of contributions versus whites. And that was just a recent study that came out by Charles Schwab and Ariel Capital. And so we did an article about that this month. So the thing about it is that, and I'm not sure how that breaks out with our readers, but I think that who may be a little bit more sophisticated, I still think there's been a little catching up to do in terms of financial literacy within certain minority communities because of either lack of information or a lack of trust within, in terms of financial institutions. Some people argue that African Americans like to invest in things they can see, things that we've known, and I still think we still are more aspirational. And in America, aspirational means material things that you can show, you can see. That's a larger culture that I've made it, I'm getting the American dream. Hence housing. Back to the housing crisis. Some people were buying houses who couldn't afford houses, who didn't meet the criteria. But that goes back to the banks. I mean, I used to be a banker, and I think a lot of these banks abandoned their basic prudent principles of cash flow, following cash flow. Cash is king. And if you couldn't justify, you didn't have the cash to service the debt, then some of these people probably should have gotten mortgages. But I think that all of us interconnected, the information, who has the information.
Absolutely. So, there's a great book out by Bob Thaler and Cass Sunstein called Nudge that's all about how to build a choice architecture for people to make the right choices, and a whole conversation to be had about how that applies to journalism, but that's a separate conversation. Dr. Deng, let's drill down a bit more real estate as the basis for this problem. We've heard a lot about, over the last 18 months, this subprime contagion that was lurking and how it's now thoroughly infiltrated the system. What exactly does subprime mean, and what is its role in the crisis?
Thank you, Chris, for putting together this event. I think this provides a great opportunity to discuss. There's a lot of sort of myths going on from the media, from the discussions. For example, one of the myths is this crisis is led by, of course, it starts with the subprime market, and then there's a common belief, say subprime is typically the market sort of lending the mortgage loans to lower-income households, minority, underserved populations. So that's this kind of federal government policy promoting the low-income housing or minority lending to lead to the current crisis. But before we start that, it's better to define what is subprime. Maybe if we can, the second page. The subprime is referred to those non-conforming loans, not conforming to the lending criteria, yeah, this one, set by Freddie Mac and Fannie Mae. Before the subprime became a sort of household populated product everyone tried to get, we have so-called conventional mortgage. That's the conforming. The conventional mortgage refers to, it's a fixed rate. Typically, it's a 30-year fixed rate. It's a level payment. Every month, you draw your payments from your monthly paycheck, and then interest rates sort of going down gradually, and then principal going up gradually. This is kind of the mortgage, this kind of mortgage housing policy can trace back to about 30s, when federal government set up the FHA. The purpose of FHA, Federal Housing Authority, is help the U.S. Household to get out of the Great Depression, get a funding to buy a house, became homeowners. So that policy sort of gradually developed, set up. This is the most popular conventional mortgage loans. When I was working at Ophel, that counts about 95% of the total mortgage lent out in the United States market. So this policy has, it's a fixed rate, it's a longer period, because housing investment is the most important investment, so it's set up a fixed term 30. Also the level payment sort of help the household to become disciplined, because it did not fix amount from your paycheck. So it's sort of the policy promoting to build a wealth for the American household, to realize the American dreams. So once this became sort of popular and stabilizing policies, it provides a lot of capitals, help the American society and household to become buy a house. And then there comes the Fannie Mae and Freddie Mac. The two companies try to securitize those mortgage loans, because it's a long-term debt, 30-year fixed rate debt. These two companies, then they have a so-called financial innovations. The financial innovation is, okay, I can separate the origination risk, the mortgage loan, typically pretty risk, by redistribution the risk and cash flow to different investors. So that's called securitizations. Once we have those securitizations, it did prove, like Suzanne mentioned, in history, there's a lot of positive perspective, provide a lot of funds to the capital market to allow the household to buy a house. And then there's a natural extension that's called subprime market, because the Fannie Mae and Freddie Mac created the securitization tools, and then there's the rest of the world say, well, we can use the same tool to extend this instrument to lend the mortgage loans to those high risk. Typically, it's a high FICO score, has a low income, poor credit history, those populations. Remember, Fannie Mae and Freddie Mac are federal charter regulated. The regulation rule, when I was working for OFEL, one of my responsibilities is to help to build risk-based capital regulation models. What the Congress told us is to say, we learned from the savings and loan crisis in late 80s. So we want to make sure Fannie Mae and Freddie Mac will be absolutely safe no matter what. So what they ask us to do is pick 4 states in the US history, the worst history, the default risk. We picked Arkansas, Texas, Louisiana, 4 states in 80s oil crisis. There's a lot of unemployment. There's a lot of default. Assuming interest rate shock increased by 600 basis points, stay there for 2 years, then shock downwards by 200 basis points, stay there for 2 years. That's an impossible scenario. And then calculate what that risk is. As Fannie Mae and Freddie Mac want to not only survive that risk, the Congress say, wait a second, you need to multiply the risk you calculated by 400%. That's totally impossible scenario. And then we calculate that model. They say, that's the regulation we want Fannie Mae and Freddie Mac to sort of survive. Fannie and Freddie immediately shoot back. They say, we are running a business just like Goldman Sachs and other company. If you put any company, any bank in that model, no bank will survive. But Congress say, well, we want to make sure you are absolutely safe, so we want this to happen. Tell you what, about a month ago, just before Fannie and Freddie was taken over by the Treasury, what we did is called it's a stress test. That's the impossible scenario. Fannie Mae and Freddie Mac, their capital reservation already reached over 95% of what we calculated impossible scenario. So something is going wrong. It's something impossible in Congress' mind happened to Fannie Mae and Freddie Mac. But what we didn't regulate when I was at OFEL until now is there's a so-called subprime market, as other people understand as a private label market, which means no one regulating countrywide, IndyMac, how they did, because Fannie Mae and Freddie Mac are not allowed to purchase those loans. And then it's totally wide. And then those risks spill over to the Fannie Mae and Freddie Mac regulated market. So the myth was whether it was the minority or underserved population lending to those groups lead to the crisis. It's still, we don't have enough data because Fannie Mae and Freddie Mac, they do have a federal mandate help those minority, but they are sort of need to go through those risk stress test modeling, but there's another 50% of the market, no one regulating them, and then.
So let me ask you this, Dr. Deng. Non-whites were 3 times more likely to have subprime loans than whites. In your view, just to kind of summarize then, how should we regard the race and ethnicity of subprime borrowers and the home ownership programs designed for them?
Yeah.
I know you say that there's still more research to be done, but just right now, what should we be thinking about?
Yeah, it is true. If you look at the distribution, the non-whites or low-income household sort of has a higher market share of the subprime loans. However, I mentioned Fannie Mae and Freddie Mac, they also have those HUD-regulated, those community CRA program, community redevelopment programs. That is also another way to lending the money to minority and low-income household. So after this mess, we need to have a very careful policy debate whether it is the lending to the minority caused the problem or it's a lack of oversight of the part of the market is the cost of problem. So in summarize, I would use one of my colleagues, Professor Raphael Bostic. He is one of the leading expert on lending to the minority. He summarized this crisis as a multi-party greed. He thinks it's Wall Street's fault, it's a regulator's fault, there's a policy error, also there's a borrower's demand. There's a household. Why household matter? Because as Suzanne mentioned, everyone we have retirement funds. And then if you look other companies like Goldman Sachs, their return is high. Why my retirement fund is return is lower? So the fund manager has the pressure. So every party got involved. And then there's a media roles that's interesting is last week I listened to NPR. There's an interview of Henry Waxman, and then they discuss. Now we understand who is the guilty party. There's Wall Street, there's regulator, there's insurers. They never mention borrowers, household. So,
well, that's a great point. Dr. Green, you do a lot of research on asset price bubbles. Building on some of Suzanne's opening remarks about them, you've looked at asset bubbles throughout history. What have been some of their fundamental features?
I'm going to take us somewhere else. But it'll be connected. For markets to work, you need individuals to make independent choices, calculations. So you need to make a choice on how much something's valued. You do. They can't be interdependent. If the choices are made in some type of interdependent way, you get misvaluation. Communication, journalism, media, right, is a tool by which individual calculations don't take place. You get a form of groupthink. You get a form of everyone thinking the same way about things. Now, I'm going to place the failure of this bubble almost at your feet, at the communication scholars. Many of you, because you have failed to enter this debate. The models that are currently being used by the economists and the behavioral school, their issues of information cascades, of herding, they are sophomoric at best. I mean, they're dilettante tricks in there. You need to enter this debate. They don't understand how information and communication brings people together and shapes where we create an episteme, a system where everyone sees risk and valuation and opportunity the same way. So just like maybe, some people say that the media or journalists somehow dropped the ball with going into Iraq, not really interrogating that the way, you're letting this debate take place without you entering it. I come back to you and ask another question. My question would be, are things different? No, they're not. Going back to the 1600s, the first society with a newspaper was the first society to have a major bubble. That was the tulip, that Dutch society. It was the first society to have a printing press, a general media where everyone could read about how everyone was making all this money in tulips. Now, tulip bubble, the canal bubble, the South Sea bubble, the Mississippi bubble, the first railroad bubble, the gold bubble, the second railroad bubble, the 1890 railroad bubble, the 1920 stock bubble, the Florida real estate bubble of the 1920s, the Japan bubble of the 1980s, the internet bubble of the 1990s, the housing debt bubble of 2000. This happens. It's a reoccurring cycle. And I would argue that what you see taking place now is individuals trying to lay blame. Who's at fault? And I would say, look, there's another story that needs to be talked about. There's a story about how, in the history of America, productivity, which is supply, and demand, which is real wages, were pretty much ran together historically. About 1980s, when the stock market took off, productivity kept rising. Guess what happened to real wages? It decoupled, started going flat to down. So you have more supply than demand. How do you move the goods off the shelf? You create a culture of debt. You create a culture of credit. And where does the surplus and profits go? Not to the common man, not to the real worker. It goes to the capitalist. And you have this huge upswing in the stock market. I don't think the question I would ask, is it an accident that the bankruptcy laws were changed right before all this thing blew up? Now, I mean, it's a question that needs to be examined. Is that, is this a coincidence or did this take place? The thing that blows me away, we're letting the financial economists come in and give us models for events that are supposed to take place every 10,000 years, yet they're happening every 6 years. Well, what's wrong? Maybe it's the models that they're using and the fact that the rest of us aren't entering and having a conversation on this debate.
Well,
right?
Yay.
I would just like to bring I'd like to bring in Kathy Kristof. How are ordinary Americans being impacted by all this?
Well, you know what, I'm going to do just what Sandy did and just deviate a little bit. There are a couple of things that I think in previous questions I just had to get to. One of them was, I'll leave Susie alone. She does some good things, but a lot of pap, and she just doesn't go far enough. The real thing is, you talked about, first of all, Schiller saying that this was a failure of financial democracy. BS, no. This was a failure of ethics, all the way up and down the chain of command, from the consumer to the mortgage brokers to the mortgage bankers, all the way up into the top level of corporations. And everybody was inspired by greed. Absolutely every single person in this chain was inspired by getting something that they actually didn't earn, didn't deserve. And you go from the borrower who looks at, everybody else is buying a house and why can't I have it? Well, the fact that I can't afford it, I, haven't worked hard enough to get that, whatever, it became secondary to the fact that, well, Joe Smith has it and he's found a way to get it. And the mortgage brokers wanted this chain to go on because every single time they sold a loan, they made a commission. And actually, the more abusive the loan they sold, the bigger the commission. And the company that was taking that loan got a bigger margin on their loan, and so they made more money. And the CEOs were making bonuses based on, the profitability of the company. And so everybody got caught up in the greed of the moment. And so there's not anyone who's blameless, but it wasn't financial democracy. It was simply greed. You could tell people about things as much as you wanted. The ability of the media to break through the mortgage broker that was sitting in your living room and telling you you could get something that you couldn't afford was impossible. There's no way to do it. And I'll tell you the other thing that is, in my opinion, different, is there was a period when I first started reporting in journalism, and I started reporting in journalism at the beginning of the savings and loan crisis and was reporting on that. So it's not like there have been haven't been other crises. The difference today is there was very much a prey-predator relationship in this whole mortgage crisis. And the ethical standards that you expect from any human being that you deal with were lapsed. It was shocking to me how people just forgot, anything that their mother ever told them, and it really and truly, the fact that a mortgage broker is going to sit across the table from you, and some of them knew their borrowers well, and I chatted with a couple who had gotten an option arm. Nice couple, should have gotten a great loan, etc. This mortgage broker sold them this thing by the time, and the paperwork was so, initially when I started covering these subprime loans, I kept on thinking, you do these personal finance stories, you tell people, read the paperwork, you really, it's all in there, really ought to do it. And I'm, hearing from all these people, well, I just didn't understand the paperwork. I'm thinking, okay, you're kind of a rube, that's bad stuff. I get the paperwork. I actually sat down with these people, and the paperwork was physically impossible to understand. There were just so many conflicting numbers, and this is a failure of the Federal Reserve, frankly, because they've got 20-year-old laws dealing with brand new financial products and acting as if, oh yeah, it's all fine. It's not all fine. The disclosures that people are supposed to look at that would protect them were very poor, and so they trusted this person who was sitting across the table from him, and on this particular loan, the loan broker for selling one loan got $23,000. $23,000. And in the disclosure documents, it's in the disclosure documents, but people didn't know what it meant. And so this yield spread premium, you know, what's that? Nobody knows. And so that's these people were able to take advantage in an astounding way. And then, you know, from the standpoint of financial or warning people, there were also a lot of other forces that were going on. We started at the LA Times, we started writing a series of stories on mortgage companies and consumers in trouble with these debts. And the moment we did a story where you'd have a consumer talking to you about, you know, the problems they had, we got ripped to shreds by a group of bloggers who were obviously acting in concert. We did some of the early stories on AmeriQuest, and you know, and followed that all the way, you know, from when they were buying stadiums or, you know, advertising in stadiums into the point where they failed, and we just every single time we had a single borrower, and these bloggers had tremendous inside information, you know, privy information that they only could have if they were working with the mortgage lenders to get that information, because these consumers were not necessarily providing it to them. And it made you skittish, because it put a little bit of doubt in the mind of the reporter. Did I get somebody who was, you know, really dishonest with me, you know, whatever. You started grilling these consumers like crazy about, you know, like, you know, everything they ever might have done. You know, did you have any parking tickets? You know, it just anything, because you knew you were going to get absolutely savaged the moment that story came out in print, and it affected editors as well as reporters. So there was a lot of discouragement for doing this. And then the last thing I just want to get back to is, more minorities got subprime loans. A large segment of those borrowers should not have gotten subprime loans. They were qualified for a normal, conventional mortgage, but they got stuck with a subprime loan. Now, where does that happen? I mean, one of the problems may have been this ethical lapse, what I really believe is the issue, and not limited to any group. Another problem may be just viral marketing. You know, if you're in a community that is more subprime, perhaps the people next door to you who got a subprime loan and couldn't actually afford, they tell you, oh, I've got this great mortgage broker. And it's only later that you find out that they ripped everybody off. And you see it in every level. I mean, I've seen it with, you see it on the high end with some of these financial planners who've ripped off, you know, a whole bunch of athletes and entertainers. You know, it's like one friend tells the next friend, and they are disproportionately hit. But minority borrowers should not have been the bulk of subprime. That was completely unfair.
Well, I'm just going to ask, bring Suzanne in one last time, and then open the floor for questions. We have until about 10 minutes after, quarter after, and I do want to leave a little bit of time for your questions. Suzanne, finally, Michael Milken was on Charlie Rose a night or two ago, and he said that in light of the current turbulence, quote, it may be more important than ever, and this is building off of Kathy's point, that the people who are the poor people in our country understand that they are part of the American dream and they have access to capital. The promise of capitalism is that you will have access to capital based on your ability. So, in conclusion, I want to ask you, is Milken on to something in your view? And is stratification of opportunities something we should be worried about today?
Well, I'm going to take the kind of Kathy and Sandy. I want to do something to answer the question, because I think it'll prove a point.
And then we'll open up for
How many of you in the room read the New York Times? Okay, and I want an honest answer to this. How many people of you religiously read the business section of the New York Times? This was just what I thought. The problem with finance and money issues are most people don't want to have to deal with them. There is incredible phobia about money, finance, other than the cash on the barrelhead that you have in your pocket. People don't understand it. And the reason that you could have greed, the reason you could have kind of the Fed not knowing what they're doing is it's a very tough subject. And so I think, again, when I think about the people in this room, it is incumbent upon the communications establishment to find a way to communicate. If you looked at prime borrowers during this whole mess, they disproportionately used adjustable rate ARMs instead of fixed rate. Now, do I think that they did that because there were some greedy mortgage brokers out there? Absolutely. But most people didn't have an individual mortgage broker. A lot of people did it online. And why did they do it? Because they saw the adjustable interest rate was like 2, and the fixed rate was like 6. So if I'm trying to do the right thing by my family, then I just pick the adjustable rate too. So I think whether we like it or not, it is an area that requires additional vigilance. And it's a very hard area to have vigilance when you're dealing in an environment that George described, which is we're in the era of soundbite. You know, people don't want to get educated about it to begin with, and this is a hard subject. And so again, I would just urge all of you to think about the topic that way.
Fabulous.
One of the problems too is journalists tend to be not financial people, right?
That's right.
And so this is like one of the problems is trying to find a journalist who actually understands what they're talking about well enough to explain it to the rest of the world. And you know, the problem is that journalism does not pay like investment banking, and therefore, if you're really good at math, what do you think can go into journalism?
Just in fairness to this audience, I have asked that question in every kind of audience you can imagine, including full of complete, you know, financial pigs or angels, depending on how you look at them. It is the same response always.
Wow.
I mean, that's very telling.
Right.
But Kathy's point is well taken because there's a trust element there. So if you're a journalist who's not as sophisticated, you don't know all the details, you have to trust the banker to explain to you. You have to then trust, and I think that went up the ladder. I mean, the Wall Street Journal, I mean, they have some level of trust with all the chairman of the various corporations, or Fannie Mae, and Freddie Mac, unfortunately.
Well, you have Paulson telling you something. It's got to happen.
It has to be true.
Okay, well, you know, it's like there is a point at which, when everybody who's in the chain of command is telling you, oh, this has to happen, you know, here you are, the lowly journalist going, okay, I don't have the economics degree, but it doesn't really work with me. I'm having difficulty with this math. But, you know, the other problem we have as journalists is we're parrots. We're not experts. We are quoting experts. And so if all the experts are on groupthink, what do you do?
Well, we have a question here, and then Mr. Shearer over here. Yes.
In 1961, when I came to this country as a 10-year-old, social responsibility was taught in school, and at some point, I don't know when, it disappeared, and sensationalism took over. There's a national almost need or demand for sensationalism when you're developing an industry like television that took off in 1950, and it has gone straight up. So, but if we can, if someone, a politician right now is telling us, I'm going to create 5 million jobs, social responsibility is, are we going to be paper shuffling or are we going to be building something? We cannot continue to be a consumer spending society forever without a solid base. As we went global, globalization took over our national agenda. In our entire primaries, my Republican folks never worked on a national agenda. They concentrate on international agenda. We, the people, have to demand stuff for us and bring these folks, no matter what they're teaching, fear or whatever it is that they're teaching, bring it back home and apply social responsibility and accountability.
Do you have a question?
No, sir, I was just so
moved. Okay.
I'm sorry if I came in late and did discuss this, but my understanding of this thing, and I know I have to simplify, is that the securitization, the normal thing you described, the 30-year loan and so forth, was when the bank expected to hold on to the loan for 30 years, they wanted to make sure the value was there, that you were a good credit. When they started bundling these things, when the stockbrokers got in bed with the bankers, when the insurance companies got involved and so forth, you have the current scandal. No one knew what was in these packages, and they sold them knowing full well they would not be responsible for claim. That all required deregulation of two specific acts, the Financial Services Modernization Act of 1999 and the Commodity Futures Modernization Act of 2000. I did cover that for the Los Angeles Times, by the way. What I discovered is that there was very little interest because basically the people who own these papers and make decisions trusted the banks. There was bipartisan support, just as now we have a Goldman Sachs Secretary of the Treasury, then we had a Goldman Sachs Secretary of the Treasury, Robert Rubin, convincing everyone in the Clinton administration it was necessary to sign off on Phil Graham's legislation. With that, and by the way, the banks put in $300 million to lobby for that first piece of legislation. There was no effective consumer representation. So what happened is basically the banking interests, in the name of modernization, bought the legislation that allowed them basically to steal legally. That's really what happened here. And with no accountability, because not only did they control the lobbying process, they have an enormous influence with the press and with both political parties. That's the source of the scandal.
Yeah, you know, I guess I'll react to you. I mean, some pieces I agree with. I think it's even more complicated than that. And let me tell you where I think, not the silver lining is, but where people try to do the right thing. There's no question it gets corrupted in the process when the sausage is made and the lobbying comes in. There was definitely a view that if you could spread risk, that you would in fact be able to lend more, have more home ownership, have more small business loans. And how do you lend more, both legally and ethically? Then you find a way to package assets. And homes were thought to be, for years, a very straightforward proposition. Again, because remember, ARMS, a lot of the new products, those innovations, those were not there. They were conventional mortgages. It was a very easy thing, actually, to model. And as Dr. Deng highlighted to you, there were very, very solid models, even if you stress test them. And the same thing was in auto receivables. The same thing was in credit cards. And if you could do that correctly and responsibly, and in what I'll call, it might be complicated, but the average smart person, you could explain that to. And I'm using average smart person and a regulator. That blew out the door when we got the level of innovation that we got. And I'll give you a good example of this. There's a bank on the south side of Chicago that I've spent time with for years, and it is in a African-American neighborhood. A bank literally turned the neighborhood around through lending homes, very high ownership in the neighborhood. And they held on to all their loans. And we had a big debate, and this was not Goldman Sachs, this was again a group of pro bono people who sat down with them 5 years ago and said, you know, if you would securitize, you could send a lot more loans out. And that's what they wanted to do. They said, how do we get more dough out there in the neighborhood? And we said, you securitize. So they went to Fannie and Freddie, they went to the rating agencies, and they had $100 million they wanted to securitize. And the rating agencies and Fannie and Freddie said, you know what? Given the risk in the neighborhood, we'll only give you 50 cents on the dollar for that securitization. And so they said, we're not doing the securitization because we think you're screwing us. They didn't have any basis for feeling they were screwed, but they just said, you know what, it's too complicated a process for us. As it turns out, the fact that they didn't securitize has allowed them the old-fashioned way, now that we have a credit crisis, to go into the neighborhood and to work with Mrs. Jones and Mr. Smith and say, let's kind of redo the loan. But the securitization wasn't an evil in itself. You have to understand that. But once you got to a level of complexity and put incentives into the system, you really did obviously have something that was out of control.
Let me just respond once to that, because that puts it back on me. The fact is,
it's not back on you.
But Title III and Title IV of the Commodity Futures Modernization Act specifically said no government regulation, no existing.
And that was terrible. Terrible.
I understand that. We talk about the communications, the role of the reporter. I can tell you, as someone who was there, and there were people, Ed Markey, even Republican Shelby from Alabama, raised a lot of questions about it. The fact is, if you looked at the markup sessions, you looked at the lobbyists in the hallway, you looked at what was going on, the trade publications and so forth, there is this overwhelming power, the money, the influence.
I agree with you.
That's, well, you can't leave that out of the picture. You can tell journalists, go do a better job.
No.
But if they're up against billions of dollars of lobbyists.
Earlier I said, part of the reason you have the problem is you've got such extraordinary concentration of lobbying expense in the process. If you have that, plus no one on the other side who really understands it, it's a recipe for disaster.
We have time for 2 more questions, Kathy.
I have a question. I see the media as playing a really positive role in the most recent, in the bailout, right? Because I think the 6-page, 3-page, whatever it was, policy plan to Congress didn't make sense, right? It wasn't well defined. And I think the blogosphere, the financial blogosphere, was sort of amazing in their reaction to it. And the economists, every economist has a blog, right? And they came out with a different plan and said, we need to have equity in these companies, right? And that vastly changed the execution of this bailout plan. And I wonder, I'm not a media person, but I wonder, how do you institutionalize that moment where all of a sudden these sophisticated financial people had impact on the media, and then the media had impact on what happened at the IMF meetings, what happened in this transformation of this bill. Because I think that, I mean, and maybe you guys don't agree with me, but I really think the media deserves a lot of credit.
The independent media.
Yeah, the independent media.
Online independent media.
I mean, the number of plans that all of a sudden appeared that were much more financially logical is quite remarkable. Yeah. And the fact that that was able, in my opinion, to rise to the top is even more remarkable.
Well, let's bundle another question with that, and then we'll go from there. Jonathan?
Just a personal question to end up. How many of you lightened up significantly before September? In your own personal portfolios?
Oh, I'd done it long before September.
Yeah, I would say the same thing. I mean, years before.
Yeah, way.
It's funny.
To where people would make fun of you saying what's wrong with you.
I run a fund on the side. I'm up 10% for the year, so I'm beating the S&P by about almost 50 points. But I came here last year at this time
with Dr. Goodnight,
and with Dr. Goodnight, and laid out this thing was going to end horribly, and because it's not extraordinary. It happens time and time again. This is a repeating pattern.
Jordan? I done the same thing. It's funny because back to where we get information. You know, there's mainstream media, of course, and then back is independent media. And the independent media, whether it be people on Pacifica Radio, you know, there's the corporate people outside of the corporate media have been talking about this bubble or predicting that this bubble is going to burst. And so some of those economists on those networks don't always get a CNN spot. They're not going to be a talking head on CNN necessarily because CNN is a part of a bigger machine. So it depends on your ability to seek the information or your desire to dig for it. But again, you could get a room of economists and 50% would say this bubble is, there's no bubble, and then 50% would say there is a bubble. So, and then all reputable, all smart. So you have to, there's also a lot of distrust of the media. I find when I go to conferences and talk to people, a lot of people, very smart people, say I get my information from back to neighbors, my friends, people, my coworkers. I talk to them and I trust my boss. And my boss, I don't read the paper. I'm going to trust what I read.
Right.
I just have a question about education. I mean, I accept my guilt both in all ways. I use my house as an ATM machine. I'm a journalist. But I'm just wondering about preventively, in terms of education, if we shouldn't be teaching, I talk a lot about media literacy, but financial literacy in our high schools. We have people graduating who don't know how to write checks. We have people graduating who don't know what a mortgage is. I mean, to me, that you should suddenly become an adult looking at buying a house and knowing nothing about any of these terms is a disgrace. I mean, do you have any feelings about it?
Well, I think it's interesting you say that because it's also occurred at a time where there's been easy access to credit. You know, the last 20 years you graduate from college, you get your credit card, or you can get a credit card in college. You know, you can go on spring break. Remember in college, there used to be a time when only well-to-do kids went to Europe for spring break, but now kids who have credit cards, you know, just charge it. And so I think that something happened in the last 20 years that some would attribute to Madison Avenue. The fact that Americans used to think debt was bad. We thought debt's not a good thing. You don't have credit card debt. That's not something, and you were sort of taught that. But then Madison Avenue sort of understood if we tell them that there's nothing wrong with debt, that you deserve it. You deserve the good life. And so the psychology changed. So therefore, then that fed into home prices going through the roof. And maybe I can't afford, my salary doesn't say I can afford this home, the second home, but I can take out money out of my existing, or buy that car that we don't really need, the SUV that I don't really need. But if I can take the equity out of my home, that's going to go through the roof, and it's never going to stop. So I think there's been unbridled optimism met with easy access to credit. It's just a bad combination. Post 9/11. Post 9/11,
it was patriotic.
And post 9/11 is also psychological too.
That's patriotic.
Well, I just want to thank our terrific